Contrary to what you might have seen across Freddie Mac's most recent publication, mortgage rates took a big hit this week, especially Thursday and Friday. Why is that? Incoming economic data. Remember, the Fed wants to see the economy slow. They want to see wage and job growth tighten. They obviously want to see inflation come down. Remember, during the last Fed meeting, when they opted for a pause in rate hikes, they released the dot plot, which projected 2 additional rate hikes by the end of 23. And Powell, during his press conference, said that any future tightening by the Fed would be dependent upon incoming economic data. So on Thursday, when we had the final reading of the first quarter GDP, was much stronger than forecasted, an indicator that the economy is much more robust than the Fed might be hoping for. In addition to jobless claims, which is its new jobless claims filed, has been a strong indicator that the labor market is tightening. It's been coming in for the last few weeks way above forecast. This time it was 30,000 below forecast. Now, some people are saying, hey, it fell during Juneteenth and potentially the holiday, caused a bit of a lag in filings. That could have been the reason. But nonetheless, the markets took off and rates worsened on Thursday. Now, we did see a bit of a pullback, a bit of rebound on Friday with PCE. This is the personal consumption expenditure. It's the Fed's favorite inflation measure. It came in at forecast and a little bit lower on the year-over-year headline numbers. So definitely good for rates, but not enough to rebound from Thursday's losses. So we did close the week, unfortunately, in weaker territory than we opened up on Monday. Now, next week, we do have ISM Business and Manufacturing. We have the jobs report on Friday. This is the biggest piece of employment and wage data each month. And then on Tuesday, we do have the 4th of July. So there will be a bit of volatility around the market's closure on Tuesday. Now, one thing to keep in mind, we just had the release of some great home price data. The first quarter of 2023, year over year, saw a huge jump in home prices, an indicator of a very strong housing market. So for those of you that are weighing whether to buy now or buy later, I would certainly caution, as even with rates falling, paying more for an asset, even with a lower interest rate, does not always translate to a lower monthly payment. You have any questions about these numbers? You want to talk about how these headlines impact rate trends? Or if you want to talk about your own pre-approval options, give me a call. This is Billy.Saylor, your mortgage professor, 571-330-5884. Have a great 4th of July.